Welcome to the Morningstar series, Why Should I Invest With You? I'm Holly Black. With me in the studio today is David Raper. He works on the Comgest Growth China fund. Welcome.
Thank you very much. Very good to be here.
So what does the fund do?
We're an equity fund, first and foremost. Like all Comgest funds, we invest in long-term quality growth. So what does that mean day to day? That means we're trying to find companies with really structurally strong positions in their market and structurally strong long-term opportunities in front of them. And when we find them at appropriate valuations, we buy them. It's not rocket science, but if we do it well, if we do it consistently, then it delivers above average returns from above average earnings growth. At the end of the day, that's it in a nutshell.
And so I suppose investing in China, we can't really avoid talking about the trade wars that's going on at the moment. How does that feed into the portfolio? Does it even affect you?
Right. To be honest, at the moment, not significantly directly. Indirectly, yes. The trade wars have affected sentiment a lot around the Chinese equity market and particularly foreign interest in it. But when we come to our portfolio is quite domestically focused. There's two reasons for this. One is that actually historically, the exporting companies from China have not been particularly high value-added exporters. That's changing, and that's part of a trade war. But historically, exporting T-shirts and shoes and simple plastic products has not been an area where we found a lot of opportunities. On the other side of the coin, we have found consistent and significant growth opportunities in the domestic consumption environment. So our portfolio naturally is biased towards the domestic consumption side rather than the export side, which is more heavily impacted by trade war conversations. So to date, we've been relatively lightly affected by the direct impacts of a trade war, but indirectly, through sentiment, we have seen some impact there.
And you mentioned domestic consumption there. One of the big stories out of China for recent years has been the consumer and the growing middle class. Is that still a strong theme?
Absolutely is. When we talk about Chinese consumption, though, you have to be careful. If it's just about volume of consumption, actually the Chinese consumer is maturing. They're not mature, but they are maturing. Now that means volume growth doesn't necessarily sustain at the same rate it did when they were a younger consumer. But the quality of that consumption, the quality of the products that they are consuming, from dairy products to insurance products, areas like this are very exciting still to us. But if you're solely looking at just more people buying more things, that's not enough today. You need to be doing more than that to attract the Chinese consumers' attention and for them to be able to upgrade their consumption towards your products. And that's really where we spend a lot of time, looking for companies who have strong brands, strong opportunities to tap into that consumer environment, or very strong product pipelines and product portfolios to offer those Chinese consumers.
And I think the other thing we hear a lot is about this slowdown in China, which doesn't seem to have materialised yet, but are things slowing?
It's a tricky question. Absolutely yes. How far are they slowing, I think, is the tricky part. So when we look at headline GDP data, the GDP data is very strong. Now, we know that GDP data has some flaws in it, particularly in China. But even if you look at the alternative data sets, they're still predicting growth, underlying trend growth rate of 4 to 5%. So a slowdown, yes, but actually still a respectable real growth rate in the underlying economy. So that's important, but structurally, remember, we're looking for companies who have their own internal drivers. So it's not simply about GDP growth, but it's about a change in consumption habits or production habits, as the case may be. So they're not solely reliant on GDP growth as their one key driver for everything else. Of course, if the economy goes negative, that would be tough. But an environment where things are at least ticking along, our companies with these structural stories can continue to tap into those structural growth opportunities and expand their market opportunity.
Well, thank you so much for your time.
Thank you very much.
And thanks for joining us.